Hey YouTube, how y'all doing today? It's Chris Cornaros here with the Cryptocurrent team, bringing you another episode of Crypto Basics with Chris K. And this week we're going to be covering everything to do with crypto lending, crypto loans, what they are, and how to get them. So I hope y'all are really excited and looking forward to this episode. But before we dive into the meat and potatoes of today's video, I do want to remind y'all that if you enjoyed today's content, please do go leave a like on the video, subscribe if you haven't already, and tell us your thoughts about it in the comments section below as well. All of that really helps us out. And let's dive right into crypto lending. Now, your first question is going to be, what exactly is crypto lending, or what are crypto loans? Well, crypto-backed loans are secured loans that use digital assets like Bitcoin as collateral. Okay. So essentially, crypto-backed loans are very similar to traditional loans, right? Like one you'd go to a bank to take out. The difference here is that you are putting up digital assets, so cryptocurrencies, up as collateral for those loans. Okay. And you're putting up an amount of crypto, and then you're receiving that loan back in the form of, a fiat currency amount. So say you put up, let's call it 5 Bitcoin. And for a round number, we'll pretend that's $250,000. The amount that you will receive in a loan is going to be $250,000. To kind of explain why that distinction is so important, we need to look at crypto loans and crypto lending as a whole compared to traditional lending, right? How do these crypto loans differ from traditional loans? And there are kind of two sides to this, right? There are pros. There are things that are better about crypto loans, and there are also things that are worse about crypto loans. So let's dive into some of the pros first. Up front, right, the kind of thing I think is the best is that you don't have to go through a credit check to qualify for a loan, right? Typically with a loan through a bank, for example, you are going to have them check your credit score, and then they will probably adjust the interest rate based on how risky of a loan you are, right? How risky of a person receiving the loan is depending on your credit history. Crypto loans, you don't need that. You put up the collateral, and the loan provider is just going to take that, and they're going to assume that you are going to pay that back plus interest. All right. And another pro here is that some loan funds are instantly available. Okay. So let's say you put up your 5 Bitcoin, that 250K you're going to receive as a loan, that's available instantly usually. Whereas with traditional loans, not so much, right? It's a longer process to actually get the amount deposited into your account. Now, those are some positive things. There are some negative things, not even negative, but aspects of crypto lending that make it far more risky than traditional lending. So like I was saying, okay, the thing to keep in mind here is that you are putting up cryptocurrencies as collateral, and their fiat value is going to be essentially what you receive back. And here's where things get a little complicated, and I'll do my best to explain this. All right. So let's say the value of Bitcoin dips down and it cuts in half. It goes from about 50,000 to 25,000. Well, you're on the hook for that missing value, right? So to keep that kind of general example going, what you would need to do is then double the amount of Bitcoin you put in. For example, if you had a 1-to-1 loan. So essentially, value Bitcoin drops. To keep that $250,000 in collateral, you would need to double and have 10 Bitcoin if it was at 25K. So as you can see, what I'm getting at here is this makes it risky. If you put up an asset that's going to depreciate, it actually hurts you. But if you're putting up an asset that is going to appreciate over time, there's no risk there. And that is one of the other benefits, is that theoretically your assets could appreciate and actually be worth more once you receive them back. And because you're receiving, a fiat amount for a fixed, amount of crypto, that crypto is going to all come back to you, right? You don't receive that fiat amount back. What you receive back are the actual coins you put up as collateral. But essentially what a margin call is, or what it does, is when the value of your asset backing the loan dips, the lender then requires more collateral from you to keep your loan. So that goes back to what I was saying, right? Because you're using digital assets that are volatile, it's not like you're putting up stable coins. that value can change. If it goes up, great. That does not hurt you in any way. But if it goes down, that does hurt you because you need to make up that collateral. And of course, that was a bit long winded, but there is another aspect of crypto loans that make these a little more risky. And that is they're not federally backed or federally insured. Okay. So in the event of a security breach, for example, you're not insured. So you kind of lose everything. Say BlockFi, for example, say they get hacked. Well, then, and all the kind of collateral they've been holding on to gets stolen. Well, there's nothing you can do, and there's nothing that BlockFi will probably do for you, right? Because it's not insured. They don't have to pay it back. The government isn't going to help you out. You just lose that amount, right? You lose your collateral. And now that I've kind of covered some of the basics, what crypto loans are and how they differ from traditional loans, I'm sure you're wondering, all right, so if this is something I want to do, how do I do it? And that's what I'm going to actually walk you through right now. It's a very, very easy process. First thing you'll have to do, of course, is put up, or set up an account on the platform you're interested in. So, for example, BlockFi or Binance or Celsius, those are just a few platforms that offer crypto loans. Then you're going to choose how much you want to receive in the loan. So, sticking with the example we had, so you want $250,000. Well, that platform is then going to go in and essentially automatically calculate how much collateral you need to put up to receive the loan. So then you're going to send over that amount and you receive the funds instantly, right? So that's great. Like I was saying, super easy. You could probably do it in under 5 minutes if you had everything already sorted out beforehand. And it's great, right? Convenient. There are pros to it. Like I said, there are some cons. But one quick side note I want to make, and this is kind of playing into the margin call concept a bit, is that like traditional loans, you're going to have to pay off the loan at face value plus whatever interest you've accrued or will accrue. That being said, most platforms, they don't actually penalize you if you pay off your loan early in entirety, which is a benefit for you compared to traditional loans. Because typically a lot of traditional loans, you will be penalized and have to pay more if you are paying it off early, right, in entirety, because the banks themselves then lose out on more potential interest down the line. And I hope you all found that interesting. And I just want to start to wrap things up here. So I'm going to quickly rehash some of the things we were talking about. All right. So although similar to traditional loans, crypto-backed loans are a bit different, right? There's no credit check. There's no credit check required. You have instant access to the funds that you are receiving in a loan. But these loans aren't federally insured. So in the event of a security breach, you could lose all of the collateral and never see that again. And additionally, because of the volatile nature of crypto as a whole, you could also be margin called and be forced to be on the hook for a lot more than you had originally staked up. But just one kind of final thought to leave you with is that while taking out a crypto loan is much easier and more convenient, there are serious risks involved, and you should be careful when doing this because it could put you in a financial hole that takes years to recover from. But guys, that's going to be it for me today. And I do want to remind you before I sign off here and see y'all next week is that if you enjoyed today's video, please do like it. It really does help us out. And if this is your first time coming here, why don't you go hit that subscribe button, turn on those notifications so you know whenever there's a brand new Crypto Basics video, our live streams, or even our full-length podcast interviews done by our host, Richard Carthon. And of course, if you have any questions, just get at me in the comments section. Let me know what you thought. If you want to know more, let me know. And if there's any videos or topics you want me to cover, then you can also put that down below as well. And of course, if you want to get at me on Twitter, my handle is in the bottom corner right down there. You can tweet at It's Me Chis. That's going to be it for me today, guys. I do want to remind you all to stay cryptocurrent.